US jobs data was stronger overnight, but it was offset by weaker services sector growth. Chair Powell is in wait-and-see mode on Fed rate cuts this year. Gold is over $2,300 an ounce. And Australian consumers expect higher inflation. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Economist Krystal Tan looks at inflation across Asia.
If the last mile inflation is stubborn, then that could potentially delay rate cuts.
But first, in 5 and 5 with ANZ, strong US jobs data combined overnight with weaker services sector growth to muddy the picture on when the Fed might start rate cuts. ADP private sector job openings beat expectations in March, with the strongest monthly gain since July last year. But ISM services sector activity was weaker than expected. At 4 a.m. Sydney-Melbourne time, the S&P 500 was up 0.35%, while US bond yields were down slightly. The Aussie dollar was up 0.7% at 65.62 US cents, and the Kiwi up 0.55% at 60.03. ANZ Head of G3 Economics, Brian Martin, says markets focused on comments just in from US Federal Reserve Chair Jay Powell.
They cannot tell from the February data whether or not the rise in inflation around the turn of the year was just a bump or something more sustained. So they want to get more data coming in. But Mr. Powell did re-emphasise that the majority of members on the FOMC think it will be appropriate to begin cutting interest rates at some stage later this year.
Number 2, Euro area CPI inflation fell to 2.4% in the year to March from 2.6%, and it was just below the 2.5% consensus. Unemployment was steady at 6.5% in February. European stocks rose and bond yields fell on views that the ECB will be able to cut rates soon. Here's Brian again.
If we do get confirmation that service inflation is easing in the second quarter, and we will get data for April and May before the ECB meets in June, that should, I think, rubber stamp a 25 basis point rate cut from the ECB then. Of course, they'll also want to see the Q1 negotiated wage rate data, which comes out in late May.
Number 3, growth in China's services sector accelerated in March. The Caixin S&P Services PMI rose to 52.7 from 52.5. ANZ Senior China Strategist Xiao Pengxing says there were 2 key drivers.
One is the demand recovery. After the Lunar New Year, business activities has rebounded because of the work resumption. Another one, I think, is the seasonality. Migrant workers returned to work in March. The Lunar New Year holiday was in February, so migrant workers returned to work in March.
Number 4. In Australia, the ANZ Roy Morgan Survey of Consumer Confidence remained at 1990 recession-level lows last week. ANZ economist Maddie Dunk says the main focus for the RBA will be on the survey's inflation expectation measure, which ticked up to a 6-week high of 5.2%.
We've seen that inflation expectations have lifted over the last couple of weeks. That might be partly due to higher petrol prices, may also be partly due to the fact that it's been the Easter period. People are buying more chocolate and cocoa prices are very high. They've tripled over the last year, and maybe people are feeling that as they go to buy those Easter eggs.
Number 5. Gold is above $2,300 an ounce this morning at fresh record highs. ANZ Senior Commodity Strategist Daniel Hines says the lift is due to ongoing expectations the Fed will cut rates, coupled with safe haven demand driven by geopolitical concerns.
Israel's airstrike on the Iranian embassy in Syria, the latest, but we've seen outside of that, some escalation in the Russia-Ukraine war with the tax on energy infrastructure over the past couple of weeks as well. So, safe haven buying as a consequence has been pretty strong.
Daniel Hines there. Now, in today's bonus deep dive interview, ANZ economist Krystal Tan looks at the outlook for inflation across the Asia region as we enter the second quarter and explains what that means for rate cuts.
Well, most Asian economies saw inflation rise in February, so that's raised questions about whether this uptick is just a temporary blip or is it a reversal of the disinflation trend. As a concern, of course, is if the last mile inflation is stubborn, then that could potentially delay rate cuts. To gauge the near-term inflation outlook, we will have to look at underlying inflation momentum. We can proxy that using the sequential month-on-month change in coal prices relative to their long-term average. We also can look at various demand indicators and also pipeline price pressures. And on balance, I think we can divide Asian economies into two categories. In the first group, we would have India, South Korea, Singapore, Taiwan, and China. In these economies, we expect disinflation to resume going forward. In the second group, we would have the Philippines, Malaysia, Indonesia, and Thailand. In these economies, we expect headline inflation to climb further in the coming months.
What are the main factors driving inflation in those economies where it has picked up?
So if we look at February data, look at the breakdown, core inflation, which is a better measure of underlying price pressures, had actually held steady or eased in the majority of economies. There were 3 economies that recorded a pickup in core inflation. That's China, Taiwan, and Singapore. But seasonal factors related to the shift in the timing of the Lunar New Year likely played a key role. So as an example, a price premium for nursery services fees during the festivities, that alone lifted Taiwan's headline inflation in February by 0.3 percentage points.
And what about those countries where inflation is flat or maybe even lower?
There were only 2 economies in February that saw inflation hold steady. That was India and Malaysia. So one factor that has helped is that retail fuel prices in both economies have not changed, right? So there wasn't a transmission from higher global energy prices to their domestic inflation. That's one of the contributing factors that helped cap inflation there.
And just looking more broadly, are there concerns enough in this slight increase in some countries for central banks in these countries to change their own views on policy rates?
Well, where we see the most upside risk for our 2024 inflation projections are in the Philippines and Malaysia. So in the Philippines, underlying price pressures are still elevated. If we look at the month-on-month rise in coal prices in the first 2 months this year, that still remained above past trends. And in Malaysia, there's been a hike to the sales and services tax that came into effect in March. So that's going to lift headline inflation going forward. Inflation risks are also tilted to the upside given the government's plans to rationalize blanket fuel subsidies later this year. So the central banks in the Philippines and Malaysia are likely to be the laggards within the region in terms of shifting to a cutting cycle.
And just finally, how important is the moves in inflation in the United States and in interest rates in the United States in the outlook for inflation and interest rates in these emerging Asian economies?
Well, the Fed moves will influence central bank decisions in the region. But for some economies, they would have a little bit more scope to prioritize their own path. And that in turn would depend on their external positions. So, for example, an economy like Thailand is probably going to prioritize domestic conditions over external. Whereas in an economy like Indonesia, the main reason why the central bank there is still on hold is because its priority is external stability. So until the US Fed pivots, that's going to hold back Bank Indonesia from making its own cuts this year.
Krystal Tan there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, April the 4th. Catch you tomorrow with a look at why your Easter eggs cost so much more this year. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.